welcome to your Monday Futures Market Outlook for July 19th, 2010. This is Patrick Ceresna. For those of you that have not had an opportunity to try eminisource.com, 30-day complimentary memberships are available, no credit card required. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. We crossed over many months ago bullishly back above the 80-week moving average, begging the question as to whether or not we're going to see a multi-year bull market off of this level. There's a couple of scenarios that we continue to stay open to. The first scenario is that we spend the remainder of the summer and fall being contained more or less to this 950 to 1,000 level on the downside of the S&P, and subsequently after putting in some summer to fall bottoms, the market turns bullish and begins a robust move into the end of the year. And while that is certainly something that we would consider, recognize that this entire rally that we've had up until now could very well have just been simply a bear market style retracement, which would then have us continue down to have the market make or retest the previous lows. Now, we don't necessarily have to favor one or the other, but recognizing that if this summer and fall we start seeing some significant deterioration in the market, we have to take into consideration the possibility that this scenario would happen. Next year, I want to take a look at the S&P 500 on the daily charts using the E-mini futures contracts. More or less, we had a very robust rally that ended up breaking not only above that 1080 level, but subsequently making a retest all the way up and toward some important overhead resistance at the 1100 level. Subsequently, the earnings announcements that came out on Friday brought in a wave of selling to the downside with one very fast, robust sell-off downwards. Now the question becomes, was that just a one-day blip, or was it going to continue on the downside? We have a number of scenarios. The first is that the 1040 to 1050 level on the downside contains the selling, including possibly even the 1060 level where we bounced off of could contain it. Subsequently, the market works itself higher. If we can get back above the 1080 level on the S&P, it would open the window for another push higher on the markets, potentially going back up toward that 1120 to 1140 area on the upside. In the same regards, though, if we suddenly saw a failed attempt in the next 48 hours to rally this market and subsequently a sell-off incurs, if the sell-off cannot be contained to that 1040 to 1050 level and we see some significant technical damage below there, we immediately have to go to look at a number of more bearish outcomes, which would eventually have us testing again about that 960 to 1000 level on the downside. But first, we're going to be watching if and where some of these immediate support levels will come in. If they do, then we'll have some room for still some further bullish price action. Just to review our key points, our thesis since January 2008 continues to be that we're in a secular bear market. We will not change that thesis until we see the extent of the sell cycle that we're currently in. If, again, like we were suggesting, that if we see good lows in the 950 to 1000 level coming in over the latter part of the summer and into the fall, we would start to look at a bullish thesis. But if we see technical damage being done and significant breakdowns, we'll have to look at all sorts of different bearish outcomes. Last week, the bulls neutralized the downside momentum until an earnings hiccup on Friday. More or less, one day doesn't indicate a reversal, but we're watching Monday and Tuesday to see if there's any follow-through that does any technical damage. We still have to consider the scenario of a multi-week rally, but in the bigger picture, we are skeptical about the sustainability of the rally into the summer. So we can't rule out a short term in terms of 1 or 2 week rally that gets up to the 1130 level, let's say on the S&P. But in the bigger picture, we think that the summer and fall will continue to be weak. It's important to stay conservative in your investment portfolio. Next year, I want to take a look at the NASDAQ 100 using that E-mini futures contract, and the circumstances here are identical to that of the S&P. Robust rally, one-day sell-off, short-term lows being put in. Question is that will this be able to follow through in the bigger picture, just like the S&P? If we don't see the bulls dig in and start reversing the market, then we could have downside targets all the way down into the 1600 to 1700 levels. But if that was just a one-day sell-off and everything is contained, we'll be looking to see whether or not they can make another attempt at that 1930 to 1950 level on the upside. Next year, I want to take a look at the U.S. dollar index futures contracts. More or less, the selling continues to be very strong and intense on the downside. With the dollar index made it all the way down to where it made its highs back in March and April before the breakout around the 82 and a half area. And this is an interesting support line. There could be a very temporary blip to the February highs around the 81.50 area, but really at this stage, this is going to be a critical moment. The selling in the U.S. dollar has been far more intense than we initially anticipated, which sort of is neutralizing the circumstances, but we'll be watching what happens in the euro. If the euro starts to roll over off of this 130 level, we could start to see U.S. dollar strength again. So we're watching the support line very carefully. Next year, I want to take a look at the gold futures contracts here, and what we're doing is seeing a little flagging formation develop, and then now again technical reversals on the downside with this breakdown candle. We were looking for in the bigger picture not only a test of this 1170, 1180 level, but we were looking for a move that potentially could even work its way down to 1140, and even under one scenario, even 1130 on the downside of this kind of a thrust lower. That doesn't make us in the very big picture bearish, but it certainly continues to give warnings of short-term weakness, and therefore treading the waters carefully for anyone that's overly aggressive long gold. Next here, I want to take a look at crude oil using the mini oil contract. At this juncture, we've seen another rally attempt that failed off that 78.80 focal point up above, and it's interesting that oil was not able to make any real upside progress while the dollar index really made its move lower. At this point, if we see any significant snapback in the U.S. dollar driven by euro weakness, we should see crude oil roll over off this level and probably come for a test into that 68.70 level down below. In the only regard where we would look at a more bullish scenario on crude would have to be one where the dollar index just goes into an outright free fall, and we see a very strong European currency rally at that stage. Maybe crude oil could make a push back up to its previous highs, but we'll be looking for the currency markets to give us the cue on the next direction of crude. Finally, I want to look at the 10-year Treasury notes, and we now slightly adjusted down our upper focal point to where the lows came in last week at the 21.5 area. At this juncture, we saw a flagging formation, and now it's technically breaking on the upside. We were suggesting that upside targets off of this flag and the previous triangle have upside targets in the 23.5 to 126 level on the upside. We completed absolutely the most bare minimum targets on the upside. We think that there's room for this to still follow through at minimum a good solid point higher or more on the upside before hitting some sort of overhead resistance level. That was your Monday Futures Market Outlook. Thank you for joining me.